Good morning, everyone. Welcome to today's lecture on the impact of legislation on credit control. This is our learning outcomes 3, be able to prepare a credit control policies. My name is Yasir Golfraz and I'm your tutor for today's session. If anyone is there, or if you can't hear me or you can't see my screen, please do let me know. Right, so today's lecture on the impact of legislation on credit control within the context of financial accounting. In this session, we will explore the critical role that legislation plays in shaping an organization's credit control practices. So let's start together. Okay, this is some command of verbs, difference between discuss, develop, analysis, and evaluate. Right, indicative contents. By end of this lecture, you will have a comprehensive understanding of how legal framework influence credit control policies, goals, and responsibilities. Legislation and control forms the background of credit control, setting the legal parameters within which organizations can operate their credit policies. So let's discuss into some key aspects. Factors influencing credit decisions. Organization must carefully consider various factors before extending credits to customers. Credit checks and referencing. Before granting credit, organizations conduct credit checks and references to assess a customer's credit worthiness. Then internal factors. There are factors specific to the organization, such as customers' past order history, payment behavior, and relationship within the company. External factors considerations include credit referencing by agencies. These agencies collect and provide credit information on individuals and businesses, aiding organizations in making informed credit decisions. Legislations and credit control. Legislation significantly impact credit control systems and policies. It ensures fairness, ethical practices, and protection for both businesses and customers. Any question if anyone is there? Okay. Discuss how legislation impact upon credit control, contract law. Additionally, we will explore how legislations sets the stages for an ethical culture within financial practices. Contract law and credit control. Contract law stands a fundamental pillar influencing credit control practices. It governs the sale of goods and services and sets the guidelines for contractual agreements. Here we'll break down the key elements. So I'll explain in my words. If you have any question, if you don't understand, please do let me know. I'll try to explain you. So a binding agreement. A contract is a legally binding agreement between parties. The credit controller plays a crucial role in ensuring that all parties involved adhere to the terms outlined in the contract. Then promise. Legally, contract law determines the legal validity of promise made within a contract. This ensures that promises are enforceable by a court of law. offer and acceptance. If an offer is extended and response is counter offer, the original offer is terminated. This highlights the importance of clear communications and alignment in credit transactions. Considerations. Consideration is the exchange of something of value between parties as part of uh, the contract. In the context of credit control, both parties must fulfill their promises or obligations to maintain the integrity of the contract. Any question if anyone is there? Okay. Other features required for a contract include uh, the parties must have the capacity or ability to contract and submit themselves to the authority of the law. So for a contract to be valid, the parties involved must have the capacity to contract and genuinely consent to the terms. The safeguards against manipulations or misunderstanding. Uh, certain certainty of terms. Uh, the terms of the contract must be clear and specific. Contract must be within the bounds of the law and feasible the perform. This prevent the enforcement of unlawful uh, practical gem practical contracts. Uh, Long-term perspective. Encouraging a long-term approaches to decision making helps mitigate short-term decision biases and promotes sustainable financial practices. Any question if anyone is there? Right. Late payment of commercial debts in Trust Act 1998. Anyone can explain me if anyone is there, or if anybody know about late payment of commercial debts? Okay, late payments of commercial debt in Trust Act 1988. So the Late Payment Act empowers businesses to address issues related to overdue payments and encourages timely settlements. Interest on overdue amount. The Act grants businesses the right to charge interest on overdue amounts from other business customers. The aim is to discourage delayed payments and ensures prompt settlements. Timing of interest charge. Interest can be charged under three circumstances: 30 days after the goods to service are supplied or completed, 30 days after receipts of the involved, or when the customers are informed of the payable amount after the agreed upon payment date. Statutory interest rate. The rate of interest that can be charged is calculated as the Bank of England base rate plus 8%. This ensures a fair and standardized approach to interest charges. Calculation of interest. The interest is calculated based on the VAT inclusive amount and follows a simple interest rate calculations. So, Data Protection Act. The Data Protection Act stands as a cornerstone in safeguarding individuals' personal data. Purpose limitations. The Act enforce the principles that personal data collected must only be used for the specific purpose it was gathered. So this protects individuals' privacy and prevent unauthorized use of their data. Consent and confidentially, personal data cannot be disclosed without the individual's consent, unless there are legal obligations or compelling reasons such as crime prevention. uh, the key principle of the acts. Uh, the legislation's framework stands a guardian of personal data, ensuring responsible handling, privacy protection, and ethical practices. By delving into the key principles, you will gain insights into how the Act safeguards the individual's rights and promotes data integrity. So, principle one, purpose limitation. The Data Protection Act established uh, that must be used solely for the specific purpose for which it was collected. The principle ensures that personal data isn't exploited beyond its intended scope. Businesses and organizations are obligated to maintain transparency and integrity by adhering to the original purpose of data collections. So, principle two, consent and data disclosure. So, personal data must not be disclosed to third parties without the explicit consent of the individual it uh, pertains to. So, however, there are instances where legal requirements of overriding legitimate reasons, such as crime preventions, may justify sharing the informations. Unauthorized acquisition of personal data is deemed an offense. Enforcing the importance of consent and data privacy. So another principle, which is a right of access. Uh, Individuals hold the right to access information that organizational holds about them. So the principle ensures transparency and empowers individuals to review and verify the accuracy of their principal data. While there are exceptions such as data held for crime preventions, this right enables individuals to stay informed about uh, how their data is used. Any questions so far, if anyone is there? Select some expectations of organization that do very simple processing and of domestic use. All entities that process personal information must register with the Information Commissioner's Office. Correcting inaccurate information, individuals possess the right to rectify factually incorrect information about them. However, this right does not extend to matters of opinions. This principle reinforces data accuracy and empowers individuals to correct inaccuracies that could impact their personal information. Trade Descriptions Act. Anybody can tell me what is it? Trade Description Act, if anyone is there. Okay. Trade Description Acts serve as a safeguard against false or misleading descriptions of product and services. Okay, so this is a criminal offense to make a false or misleading statements about the goods or services being provided. For example, misrepresented in any way. So, Unfair Contract Terms Act. The Unfair Terms Act aims to establish fairness in contractual agreement, particularly those that favor vendors over consumers. So clear language the key, that the key components are clear language, unfair terms, contract terms that provide disappropriationate benefits to the vendor and undermine consumer rights are deemed unfair and are not legally binding. Business liability. This statute primarily addresses business liability, test of reasonableness, while some exclusions of liabilities are allowed, excluding liability for death or personal injury is prohibited. Other losses are subject to a test of reasonableness. Then it's a very common Consumer Rights Act. So the Consumer Rights Act 2050 consolidate consumer legislations and impose buyer with specific rights. Consumer Act applies when the title of the goods has passed from the vendor to the buyer and states that as a buyer you have 3 statutory rights. So good of satisfactory quality. Number 1. Under the Act, goods must be satisfactory quality and free from faults and damage upon receipt by the consumers. Goods matching descriptions. Sellers must ensure that goods match the descriptions provided. This ensures that consumers receive products that align with what was promised. Fit for purpose. Good must also be fit for their intended purpose. This means that should perform as expected based on their descriptions. Consumer Acts 1974 and 2006. The Consumer Act 2000 business that offer goods or services on credit or lend money to consumer to be licensed by the Office of Fair Trading. So licensing requirements, business, goods, services, or lend money or consumer must be licensed by the Office of Fair Trading. Then early settlement. Borrowers have the right to settle a regulated consumer credit agreement early by giving notice to the lender and paying a reduced amount. This empowers consumers to manage their finance more flexibly. Disclosure of information. Sellers must provide clear and comprehensive information to borrowers or hires before entering into a consumer credit or hire agreement. Legal consequences. Operating without the required licensing arrangement is considered a criminal offense and can lead to fines or imprisonment. Settlement information. Borrowers are entitled to receive information about the amount needed to settle their credit agreement. This ensures transparency and clearly in managing their financial commitments. Any question so far, if anyone is there? Okay. So develop a credit control policy for a specific organizational which complies with the organization objectives. So credit control policies, overall terms, procedure for offering credits and control. So overall terms, credit control policy aims to strike a balance between facilitating businesses growth and mitigating credit risks. So when credit risk is an integral part of our business model, so we emphasizes prudent risk assessment and mitigations. Procedures and offering credit. Procedure for offering credit. Our policies outlines standardized procedure for offering credit. This includes evaluating the customer's credit worthiness, assessing risk factors, and determining suitable credit limits. Then control. We exercise strict control over extended credit. Our policy involves our tiered approach to credit approval based on the customer's credit worthiness. High-risk customer undergo more rigorous assessment and approval process. Then assessment of credit status. Assessment of credit risk means that there is a possibility that the debt will become irrecoverable. A credit assessment is a judgment about the credit worthiness of customer, providing a basis for a decisions as to whether credit should be unacceptable risk. The reassessment is vital for consumers seeking higher limits or expansion of trade. So chasing slow pairs or policy outlines systematic procedures for addressing slow paying customers. This includes follow-ups, reminders, and escalations protocols. Then customer visit, in some cases, we offer on-site visit to assess the customer operations and build a strong understanding of their payment capability. And credit legislations, credit control policies strictly adhere to all relevant consumer credit legislation to ensure fairness and compliance. Assessment of credit status. There are two type of informations. One is internal and one is external. In internal information, assessing the credit status of customer involves gathering both internal and external information. So when considering internal informations, staff knowledge, existing customer credit limit. So staff knowledge, experience in dealing with the customers, contribute insight into their payments behavior and history. So existing customer increasing, if an existing customer seeks a higher credit limit, analyze their past payment performance. So external information, financial analysis of customer accounts, conduct an in-depth review of the customer's financial statements, bank reference from the customer's bank, trade reference, contact trade partners to assess the customer's payment habits, credit reference agencies, obtain credit reports from reputable credit agencies, reference agencies. You can get information, publicly available information about the customer's legal structures from company house, so media publications and internet management accountants from customers assessment process. So assessment process involves analyzing internal and external information, considering both qualitative and quantitative factors. Type of references. You might know about if you ever apply for a finance loan or everything is references are a key part of applications or process. So bank references, these inquiries help gauge the customer's banking relationship, financial stability and capacity to fulfill credit obligations. Then trade references, insight from trade partners provide valuable and important information about the customer's payment behavior or reliability within the industry. Also remember the quality and accuracy of references play a very important role in decision-making process. So each reference should be analyzed carefully and followed up if necessary, ensuring a comprehensive assessment of the customer's credit status. Credit reference agencies play a crucial role in assessing the credit worthiness of businesses by providing comprehensive information. Some key points are, that content of agency report, legal data, commercial data, and uh, credit data. So these agencies basically compile data to create a comprehensive profile of a business, adding supplies in making information credit decision. So other information, press, historical financial data, management accounts, companies registry, search, county court reports, internet search, and credit circles. Any questions so far? If anyone is there, okay. Ratio analysis. Anybody can explain me ratio analysis if anyone is there? Hello? Okay, so ratio analysis, credit reference agencies, ratio analysis provides valuable insights into a business financial health, helping to predict future cash flows. Key ratios to consider include, if you can see around, like a profit margins, assets turnover, measures how effectively assets are utilized to generate revenue. Return on capital employed means indicates the return generated from invested capital. Then journal measures the purpose of debts in the capital structures, working capital cycle, uh, the time it takes to convert working capital into cash, interest cover, interest cover. So this measures the ability to cover interest payment using profit. And then uh, quick ratio assessing liquidity by considering only the most liquid assets. Current ratios evaluate short-term liquidity by comparing current assets to liabilities. Then accounts receivable, uh, collection period, uh, measures the average time taken to collect receivables. Inventory holding period indicate uh, indicate how long inventory is held before being sold. And account payable payments period measures how long it takes to pay supplies. So information limits. The credit controller's primary concern is the indication of future cash flow, such as liquidity, gearing, and working capital, utilizing a combination of sources, including credit references, agencies, suppliers references, and ratio analysis. So ensures a comprehensive assessment of a business credit worthiness and helps make informed credit decisions. So any question so far, if anyone is there? Credit scoring. Credit scoring is a statistical method used to evaluate the credit worthiness of individuals or organizations. So various entities like banks, utility companies, insurance and uh, insurance companies and landlord employ these techniques to assess whether a borrower or customer can meet their financial obligations. Factors considered. Credit scoring takes into account several factors to determine credit worthiness. Some example of factors include, here is a financials, uh, information related to a business financial performance and stability. Then business details, relevant details about the nature and size of the business. Then uh, you know, publicly available data, payment record, owners, and economic index. So external economics factor that may impact on the business ability to repay. Uh, Next one is granting credit using credit control information. Credit control information should be used in various ways. Granting credit control information serve as a foundation of credit decisions. Full grant information helps determine or if the credit request to approved entity entirely. So provisional grant credit may be granted initially but subject to future reviews. Modified terms decision on providing less favorable credit terms than requested. Denial of credit information helps identify high-risk situations where credit should not be extended. So second is a credit rating. Utilizing credit control information, improve credit rating and management. So immediate posting, promptly recording invoices and receipts, quick query resolution, clearly customer queries promptly, credit limits, monitoring, orders against established credit limits, customers' history, evaluating historical payment behaviors. Uh, then high risk review, credit reviews, ongoing monitoring, high risk focuses, holistic assessment, considering overall payment history and behavior. So basically, credit scoring provides a structured approach to assessing credit worthiness by analyzing various factors. So this information is, uh, pivotal for making information credit related decisions, whether a granted credit, establishing credit scores, or credit rating, or conducting a credit review. Any questions so far, if anyone is there? Analyze the key component of credit policies. In this scenario, the company assess both existing and new customers, makes credit decisions and ensures effective monitoring and management of credit relationships. Uh, assessment of customer for credit, when dealing with the credit request from existing or new customers. Lawson Limited initiates throughout assessment process. This process involves a combination of internal and external checks to evaluate the customer's credit worthiness. So here is giving an example of a company which is Lawson Limited. So their process involves combination of internal and external checks. So internal check analyze of accounting reports from colleagues, and then external checks includes bank and credit rating agencies, suppliers references. So based on the finding from the assessment, the credit decisions is made. If the customers is deemed suitable for credit, they are offered the desired credit arrangement. On the other hand, if the customer's credit worthiness is uncertain of unfavorable, a polite refusal may be provided. Alternative, such as cash trading, might be proposed in such cases. So, any question if anyone is there? Okay, here. Credit rating. You work as a credit control manager for Loss Unlimited, which use a credit rating system to assess the credit status of new customer. The credit rating scoring system is used to assess the risk of default by calculating key indicators, comparing them to the table and calculating the aggregate score. The system is set out below. So here is, understanding the credit system. The credit rating system at Lawson system specific scoring criteria based on key financial indicators. So these indicators help assess the credit worthiness of new customer by analyzing their financial stability. So the credit rating classification and aggregate scores, calculated scores from the key indicators are aggregated to determine the customer's overall credit rating. So credit rating classifications means a low risk, a very low risk aggregate score between 60 and 21 here. So then a low risk aggregate score between 20 and 1, then medium risk aggregate score between 0 and 24, then high risk aggregate score between 25 and 50 here, and then very high risk aggregate score between 50 and 160. So basically, in conclusion, the credit rating system at Loss Unlimited is crucial tool for assessing the credit status of new customers. By analyzing key financial indicators and calculating aggregate score, the system classifies customers into different risk categories. This process aids in making informed decisions about granting credit based on the potential risk of default. Thank you. So here analyzing where we will assess the credit worthiness of Sunny Limited, a potential new customer based on their financial information. By evaluating key information indicates and applying a credit scoring system, we will determine whether granting a credit limit of 20 to 45,000 pound to Sunny Limited is advisable. Based on our evaluation, Sunny Limited financial indicators, we recommend accepting the requested credit limit of 45,000 pound. So their consistent rating indicate a low risk profile over the 2 years, making them a suitable candidate for credit. However, continuous monitoring and regular updates of management accounts are essential to ensure ongoing credit worthiness. Evaluate the importance of monitoring a comprehensive credit control policy. Effective credit control management plays a vital role in safeguarding financial stability, minimizing risk, and for fostering positive business relationships. So by the end of today's discussion, you will understand how proactive credit control policy can protect revenue, streamline process, and enhance overall financial health. Safeguarding proceeds domestically and internationally. A proactive credit management approach is instrumental in protecting proceeds on both domestic and international fronts. So, key components of this approach: clear communication and streamlined process, Effective credit control requires clear communications between all stakeholders. A streamlined process ensures that credit-related activities are efficient and consistent. Risk reduction and debt collection saving. Well-structured credit control policy reduce the risk of bad debts. Effective process save money on debts collection efforts. Client centric and country specific understanding. The ideal manager understands the unique needs of finance of clients and different countries. Then monitoring and news improvement uh, involves monitoring and team performance and reporting, and enables continuous improvement, proactive adjustment based on performance, data optimized credit management strategies. Benefit of proactive approach. A proactive credit control policy yields several benefits that contribute to overall financial stability and growth. Timely, involving and accurate billing, monitor unbilled revenue and missing data. Accurate billing, enhance transparency and trust in business transactions. Smart objectivity and accountability. Uh, Providing weekly billing and data summarize, improves communication and strengthens relationships. Any questions so far, if anyone is there? Credit terms and conditions. Credit terms and conditions plays a critical role in establishing the parameters for offering credit to customers. Uh, these terms outlines the rules, limits, and expectations related to credit transactions. So, some key concepts related to credit terms are conditions are, here you can see credit limits, credit terms, cash on delivery, cash with order, cash before shipment. So, cash on credit limit, the maximum amount that a customer is allowed to have outstanding as credit. Uh, the limit ensures that the customer does not exceed a certain level of debts. Then there is a credit term, the length of time for which customers are permitted to have outstanding amounts. So it's specific when the payment is due after the goods or services have been delivered. Uh, then cash on delivery or COD payments is required at the time of delivery. No credit is extended beyond the moment of receipts. Cash with order payment is required when the order is placed prior to the delivery of goods or services. And cash before shipments payment is made before the goods are shipped to the customers. It ensures that the payment is received before the products are dispatched. So any questions so far? Refusal of credit. The decision to not extend credit to a potential customer based on the assessment of their credit worthiness. There are several reasons for refusing customers. Poor or non-commercial bank reference, negative trade references, unfavorable credit agency report, indications of business weaknesses from ratio analysis, a lack of historical account due to being a new company, communication of refusal. When credit is refused, is crucial to communicate these decisions effectively. So we should clearly explain the reason of for refusal, provide a tactful and diplomatic communications, clarify any future actions that the potential customers may need to take. emphasizes that the option of trading on cash terms remain available. Encourage the customer to empower their credit worthiness for potential credit terms in the future. Any questions so far? Uh, Communication of refusal of credit. We, this crucial interaction requires tact, diplomacy, and strategic approach to perceive relationship and business approach opportunities. So by the end of the decision, you will cross the nuances of effectively convincing credit refusal while leaving the door open for future collaboration. Uh, Communication of credit refusal to a potential customer demands careful handling to ensure a positive outcomes for both parties. So, successful communication, tactful and diplomatic approach deliver the refusal in a respectful and empathetic manner, and then choosing words that convey understanding and consideration for the potential customer situation, clear explanations of reason, provide transparent reasons for the credit refusal, clearly outline factors that contributed to the decision without causing offense, and then future actions and expectations, communication, uh, any necessary steps to actions that the potential customer can take moving forward, set realistic expectations to guide their next course of actions, related retaining business potential, emphasizes the willingness to continue doing business with the customer on cash terms, highlights the company's eagerness to maintain a positive relationship, and then acknowledge that while the refusal may not be ideal, it is pragmatic business decisions, express optimism about potential future collaborations, encouraging the customers not to dismiss the possibility, future considerations, mention the potential for reassessment in the future, indicate that with additional information such as financial statements and references, the decisions could be revisited later. E-learning, granting credit, legislation, and legal actions. You can check these websites and references here. So that's it for today. Any questions, anyone? If anyone is there? Okay, so that's it for today. And if there is any questions or any issues, please drop me an email at yasser@ukversity.co.uk, and we'll meet tomorrow for our next session. I believe that is our last session for assignment discussion. So that's it for today, and I'll see you tomorrow at 10:30. So bye for now. So have a good day and bye everyone.